Welcome to the Deep Dive. We're here to cut through those dense corporate reports and get straight to the core insights. Today, we're looking at Hasbro. Now, they're more than just toys, right? This is a company that's been shaping play for over 100 years, really connecting with generations. Our job today is to dive into Hasbro's 2024 annual report. We want to unpack their big strategic moves, look at the financial details, and see what their outlook really means. We're pulling all this straight from their 2024 Form 10K, so you're getting the key stuff directly from the source. Okay, let's unpack this.
Right. And the report itself kicks off with quite a positive framing of 2024. They call it a year of great progress. They talk about becoming a healthier, stronger organization, mentioning improvements to the balance sheet and how they operate. This really sets the scene for their new big strategy, which they've called Playing to Win.
Playing to win. Okay, that sounds pretty focused. What's the main idea behind it? What are the key pieces?
Well, the core idea is a big shift, a strategic pivot towards what they're calling play in partners.
Mm,
And it's built on five main pillars, or strategic building blocks as they call them. First up is profitable franchises. This is all about the fundamentals, innovation, good partnerships, being efficient, disciplined with costs, and really executing well in stores. It's about maximizing those big established brands they own.
Right, getting the most out of what they already have makes sense. What's pillar number two?
Number two is aging up. This is interesting. They're actively looking to expand beyond kids, targeting older demographics. They specifically note that consumers aged 13 plus are becoming a bigger part of the market share for purchasing. And you can see why, right? A lot of the brands have huge nostalgia appeal or offer sophisticated play like tabletop games.
That feels like a significant shift for a company so linked with childhood. How do they actually plan to do that? Is it new kinds of products, different marketing?
It's likely a mix of both, and yeah, it definitely presents challenges, which kind of leads into the third block. Everyone plays. This just reinforces the idea of engaging across the whole play spectrum, trying to bring in new, diverse groups. Then fourth is digital and direct. This is huge, embracing video games, digital tech, selling directly to consumers, meeting people where they are now, essentially. And the fifth block is partner scale. This means using the investments and reach of their partners to boost their own brands through licenses and strategic deals. And the overall goal here is pretty massive. They want to grow their reach from over 500 million fans today to over 750 million by 2027.
Wow, 750 million. That is ambitious. Have they shown any concrete results from all this restructuring yet? They mentioned cost savings, I think.
They did, yeah. Big numbers. Around $600 million of gross cost savings and $320 million of net cost savings.
Okay, quick clarification for us, gross versus net savings. What's the practical difference there?
Good question. So gross savings is the total amount they cut from expenses. But net savings, that $320 million, that's the amount that actually improved their profit after accounting for, say, reinvesting some of that money elsewhere. And that $320 million is really key. It shows that renewed discipline they talk about. It's fundamental for setting them up for, multi-year growth and better margins down the line. And what's really interesting here, you can see how their recent leadership changes fit right in. Bringing in people like John Heitz for gaming, Holly Barbacovi for HR, both started July 2024, that directly supports driving innovation and this whole playing to win strategy. They're putting the people in place.
Okay, that strategy overview is helpful. So let's get into the segments. How did they actually perform under this new plan? Let's start with Wizards of the Coast and digital gaming. Report says they were up 4% year over year with an operating margin over 40%. That sounds strong. What drove that?
Oh, Wizards has been a real powerhouse for them. That operating margin over 40% is incredibly strong. Magic. The Gathering was already a billion-dollar brand back in 2022, and it just keeps growing. They're partly through these really smart collaborations with other IPs, like the Lord of the Rings that they did. That was huge. And their digital gaming strategy, they say it's key to their success. And you can see it. Look at Monopoly Go, that free mobile game from Scopely in 2023, immensely popular. You have Baldur's Gate 3, based on Dungeons & Dragons. That game won basically everything in 2023, Game of the Year awards galore. Plus, they bought D&D Beyond back in 2022. That's become the main digital hub for D&D players. Deepens the connection. They're also developing games in-house like Magic, the Gathering Arena. So yeah, they're leveraging those big brands and characters in the digital space, and they see clearly high growth potential there.
Definitely sounds like a winning segment. But then you look at consumer products. The report says net revenues were down 12% in 2024. But then operating results went from a loss of about $65 million in 2023 to an operating income of $115 million in 2024. So revenues down, profit way up. How does that work? Seems like a bit of a contradiction.
It does, but it actually points to some effective internal changes. The revenue drop had a few causes. They exited some businesses, they out-licensed some brands, the product mix shifted, they had fewer closeout sales compared to the year before when they were clearing inventory. And, wider industry trends played a part too. Specifically, brands like Nerf, Star Wars, Marvel saw lower revenues. A lot of that was timing the year before, had big movie releases driving sales. Power Rangers, Hasbro Gaming, Transformers were also down, again, partly due to movie timing for Transformers.
Okay, so sales dip for some big names. What explains that big jump into profitability then?
That came from a few key areas. A better, favorable licensing product mix, meaning the license they kept were more profitable. Also, big gains in supply chain productivity and those cost savings initiatives we talked about earlier, they really made the operations leaner. So better efficiency more than made up for selling less volume. And they did have some wins that helped offset the declines. FURY's reintroduction in 2023 did well. The refreshed B-Blade line in 2024 and My Little Pony trading cards through licensing brought in good revenue. Oh, and regionally, Asia-Pacific was actually up 12% in this segment. So some bright spots.
Got it. And then the entertainment segment, wow, an 88% decrease in net revenues. That number really jumps out.
It's a huge number, but there's very specific context. It was primarily driven by lower net revenues as a result of the sale of the E1 film and TV business. That happened late in 2023. They basically sold off a massive part of their entertainment division. This wasn't just about the money, it was a strategic move, signaling they're getting back to their core focus on play and their own IP, shedding parts of the business that didn't fit as well. So the remaining strategy is much tighter. It focuses on Hasbro-branded entertainment content. Think Peppa Pig, My Little Pony. And the upcoming Transformers 1 animated movie, that's set for September 2024. It's about integrating entertainment with their core brands.
And you mentioned direct connections earlier. They highlight Hasbro direct platforms like Hasbro Pulse, Secret Lair. That seems like part of building that core brand relationship too.
Absolutely. Those direct-to-consumer channels, they let Hasbro sell exclusive stuff right to the fans, engage with them directly, they get valuable feedback, learn what fans want, and build a much stronger sort of personal connection. It's about controlling that relationship.
Okay, let's zoom out to the overall company financials now, because the numbers tell a dramatic story. Consolidated net revenues down 17.3% to about $4.1 billion in 2024. But operating results, a huge swing, from a loss of over $1.5 billion in 2023 to a profit of $690 million in 2024. That's an enormous turnaround. What was the main reason for that shift back to profit?
It is a striking reversal. And the biggest single reason was the absence of huge non-cash charges that hit them hard in 2023. Remember the D1 business. In 2023, they booked a massive goodwill impairment charge of nearly $1.2 billion. Basically, they had to admit on paper that the acquisition wasn't worth what they thought. It's a non-cash accounting thing, but it wiped out profit. Plus, there was a loss on disposal of business of over $500 million, also tied to selling E1. Take those huge one-off hits away, and the 2024 operating profit looks much, much healthier.
Right, that makes the swing much clearer. It wasn't just operations improving, it was also removing those massive write-downs. So beyond that main driver, what are the key financial numbers, maybe from the income statement, that you think people should know?
Okay, key metrics. Net earnings hit $394.4 million in 2024. Compare that to a loss of almost $1.5 billion the year before. That's huge. Basic earnings per share followed that $2.77 profit per share versus a loss of $10.73 in 2023. And importantly, their cost of sales got better. It dropped to 28.5% of revenue in 2024, down from 34.1%. That improvement came from, well, selling less overall, but also lower charges for old inventory, better supply chain performance, and those cost savings kicking in.
So definitely signs of improved efficiency there. What about the balance sheet, cash flow? How healthy do they look?
Pretty solid. They ended 2024 with $695 million in cash. They also paid down about $83 million in debt. And the really encouraging sign is operating cash flow. It was strong at $847 million. That's up $122 million from the year before. And if you connect that back to the strategy, that stronger cash flow is what lets them reinvest in the business, pay dividends, and keep chipping away at debt. It fuels everything else.
Speaking of dividends and shareholders, what's the story there? How are they returning value?
They returned a good chunk, $390 million to shareholders in 2024. And they really emphasized their commitment to a category-leading dividend. They want to keep that attractive. Now, share buybacks. That's interesting. They still have authorization to buy back about $241 million worth of shares from a plan started way back in 2018. But They didn't actually buy back any shares in 2024 or in 2023. They say the timing depends on things like the stock price and how much cash they're generating. So they're being cautious, maybe waiting for the right moment. It's also worth noting the report includes that 5-year shareholder return graph. It shows Hasbro stock basically went from $100 in 2019 down to about $65 in 2024. Meanwhile, the S&P 500 doubled to $200 and a key consumer index hit $199. So Hasbro has definitely underperformed the market over that period.
Yeah, that chart really highlights the challenge ahead in terms of rebuilding that long-term value for investors.
Absolutely. The 2024 turnaround is positive, but there's ground to make up.
Okay, so looking forward then, what does the report indicate about their plans for continued growth and keeping that disciplined execution going?
Well, they talk about this ongoing multi-year push to transform their global supply chain. They want it to be best in class. It's about boosting performance efficiency, operating model integration, and organizational accountability. Basically, making the whole system work better, faster, cheaper to support growth.
But it's not just internal stuff, right? The world outside keeps changing. What risks are they flagging?
Yeah, they're pretty open about the external pressures. Things like changing consumer tastes, especially how fast kids are adopting technology, and the speed of change with things like artificial intelligence. That's a big one. They also mention how competitive the industry is, low barriers to entry. And they specifically say AI could make it even more competitive, maybe lowering design costs for rivals. And then the usual suspects, ongoing global supply chain challenges, tariffs, labor, logistics. Those haven't gone away.
And you mentioned legal issues earlier. Sounds like there's some active challenges there too.
Yes, the report details a couple. There's a putative class action lawsuit from a firefighter's pension fund and a putative shareholder derivative action from an individual shareholder. Just to clarify, putative means it's proposed as a class action or derivative suit. Hasn't necessarily been certified by a court yet. Both lawsuits basically allege the company made false or misleading statements about its inventory levels. Hasbro says they plan to vigorously defend themselves. But yeah, these kinds of lawsuits can be a distraction and carry reputational risk, even if you fight them hard. It really brings up that whole challenge for big companies. How do you manage these complex legal things while staying focused on running the actual business?
Definitely a balancing act. Yet, despite all those headwinds and legal things, the CEO sounds quite bullish in the report, saying Hasbro is well-positioned and the best is yet to come.
Right. It's a strong note of confidence. They clearly believe in the strategy and the changes they've made, even with the acknowledged challenges out there.
Okay, so let's wrap this deep dive up. It seems clear Hasbro went through a major reset, moved from big losses back to solid profit in 2024, driven largely by that playing to win strategy, focusing back on core brands, cutting costs, and really pushing into digital.
Exactly. They're trying to smartly blend the old favorites with new digital ways to play, using partnerships, while keeping really tight grip on operations and finances. It's about building a stronger foundation in a tough market.
So here's something to think about. Given how fast things are changing, competition, AI, tech, everywhere, how might Hasbro's whole idea of play need to evolve even further? What new kinds of engagement might they need to invent to hit that ambitious 750 million fan target by 2027? Something to chew on.
Thanks for joining us for this deep dive into Hasbro's 2024 annual report. Hopefully you feel a bit more informed.